Happy Thursday out there, Team 42. It's your skipper here, Darius, now to present our macro minute for Thursday, August 8th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, JP Morgan says 3/4 of all carry trades have been wiped out. Should you believe them? What do the latest jobless claims data signal about the risk of a U.S. recession? And what do the preponderance of leading indicators signal about the risk of a U.S. recession? Our answers are, given the U.S. dollar's dominant role in cross-border financing, it is highly unlikely that 3/4 of all carry trades have been wiped out. The entire global financial system is essentially one gigantic carry trade. So the assumption that all these positions even need to be wiped out is a flawed assumption. The latest jobless claims data offer mixed signals with respect to the risk of a developing recession in the U.S. economy. There's already been one false alarm signaled by jobless claims in this business cycle, and had you overreacted to that signal, you would have missed out on the bulk of the 33% total return in the S&P 500 or the near 200% total return in Bitcoin since we pivoted from bearish to bullish back in January of 2023. The upside capture ratios provided by our systematic KISS portfolio construction process and our discretionary risk management overlay, aka Dr. Mo, were obviously less than 100% of those numbers, but they are incomparably higher than the likely negative upside capture ratios of the bear point purveyors, constantly causing investors to miss out on gains, and you know exactly who they are. The preponderance of persistent leading indicators of the business cycle currently support our call for U.S. growth to slow and for the labor market to continue softening over the medium term with limited recession risk throughout. That will eventually change, especially the part about limited recession risk. And when our Bayesian inference process spots that critical inflection, we will sound the alarm bells in real time for 42 Macro clients. Transitioning to our 42 Macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding credit and repo freezes. That's hello, Darius. Can you help us better understand credit repo freeze risk? If it's too long to describe, just provide links to sources. So it's not too long to describe. It's pretty easy to describe. And what we mean by a credit market freeze is that the market for primary credit issuance freezes up. So the market for primary credit issuance is when corporate borrowers are demanding capital from investors. And so if that market really grinds to a halt or slows, much like it did in December of 2018 or in March of 2020, that would be a big red flag for the Fed that the financial conditions are significantly too tight and they need to ease policy in short order. And if the repo market freezes up, much like what we saw in August or September of 2019, and obviously during COVID as well, that is a situation where the folks who are trying to get capital in the repo market, trying to finance leverage in the repo market, the collaterals, the haircuts for the value of the collateral that they're supplying can rise materially. So their demand for that leverage tends to decline significantly. And so you tend to see a significant reduction in the overall amount of new repo financing activity. And you also see a shrinking of the amount of hypothecation in the repo market, which is the extension of the same piece of collateral over and over to different borrowers in order for them to obtain leverage. You see that sort of daisy chain kind of contract as well. So obviously we haven't seen any evidence of that thus far. But if we did see evidence of that, we do expect the Fed will embark on emergency rate cuts, perhaps even completely get rid of its fake Q quantitative tightening program and pivot to something that looks a little bit more like balance sheet expansion. But again, we're a long way away from that in S&P 500 points in terms of Bitcoin price units as well. We need to see a lot more volatility in asset markets globally across asset classes to threaten a freeze of the credit and repo market. And it may be coming. Again, we talked about earlier this week how we thought endogenous market risk, i.e. funds blowing up and causing other funds to blow up in terms of the risk management systems kind of triggering each other. We think that market risk is a much bigger market risk than the exogenous market risk, which is the risk of a recession developing, causing investors to broadly degross their portfolios. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, August 8th, 2024. Best of luck out there today. Everyone have a wonderful day, and we'll catch you back here tomorrow.